Deferred expenses are also called prepaid expenses. So it's exactly what it sounds like. It's an expense that you're going to incur in the future, but you're going ahead and paying for it now. You're prepaying. So prepaid expenses are actually recorded as assets. So anytime you see something that says prepaid, it's being recorded as an asset. So for example, if you go ahead and pay a 6-month lease up front, then the account that you'll record that in is prepaid rent. The same goes for insurance. If you pay a 6-month insurance policy up front, then it's called prepaid insurance. If you are subscribing to a magazine and you pay for the whole year up front, then that will be called prepaid subscription. Supplies are actually also a form of a prepaid expense, and that's because you purchase a bunch of supplies and then you use them over time. So when you first buy them, you haven't used them yet, so you haven't actually incurred the expense. So the asset that we use for that is called supplies. There's actually another special type of a prepaid that's called essentially when we capitalize or when we put machinery, equipment, different types of assets on the books. So over time, we actually record the expense of those, and that's called depreciation. So we'll talk about that a little bit separately. So prepaid expenses, when we first record them as an asset, that asset expires over time. So what that means is that we record the whole thing as a prepaid expense to start with. Then as time passes, it actually becomes an expense 1 month at a time. So for instance, if you pay a 6-month lease, you would record that as prepaid rent. Well, after the first month, you will have incurred that first month's rent expense. So you will then take 1 month of that prepaid rent and move it over to rent expense. And then the remaining 5 months of the lease will still be recorded as prepaid rent. So as I mentioned, prepaid expenses are assets. They represent expenses that are paid in advance, but not yet incurred. So like I mentioned, a company paying an insurance policy for 6 months. So when we look at the journal entry that they initially make when they actually make the $600 payment for the policy, notice that they debit prepaid insurance. Remember, prepaids are assets, so we debit the prepaid insurance, and they're paying cash, so they credit cash. So that's the initial journal entry. That's not what's considered the adjusting entry. The adjusting entry is at the end of the period when some of that prepaid expense has now expired and become an actual expense. So obviously if it's a 6-month policy for $600, that means that it's $100 per month. So at the end of the first month of that policy, we have to look at the books and adjust them to more accurately reflect the actual situation. So since 1 month of time has passed, we now record insurance expense for that 1 month. So $100 insurance expense is recorded. The other part of that is that we have to reduce the overall amount that we initially put into prepaid insurance. So here we put $600 in the prepaid insurance account. Well, if now we're taking out 100 of that and recording it as insurance expense, then we have to also reduce the prepaid insurance expense balance by $100. So then at the end of this transaction, prepaid insurance will then have a balance of $500. And then you will continue making the same adjusting journal entry each month until all the prepaid insurance has been reflected as an expense. So now we'll do our own example. So Fast Forward is a company. Fast Forward pays a 24-month insurance premium on December 1st in the amount of $2,400. So we'll go ahead and record that initial entry on December 1st. Remember, this is not the adjusting entry. This is just to give you an idea of what actually happens with the journal entries. So on December 1st, a 24-month insurance premium was paid for $2,400. So at this point, we're not recording any expense. We're recording a prepaid. So we debit prepaid insurance. And since cash is being paid, we credit cash. And that total amount was $2,400. That's on December 1st. So then the end of the period rolls around, which is December 31st. At this point, 1 month's worth of insurance has been used just due to the passage of time. So now we have to record 1 month of actual insurance expense. So obviously, if it's a $2,400 policy over 24 months, that means it's $100 per month. So on December 31st, we record insurance expense of $100 because due to the passage of time, 1 month of insurance has now been expensed. Then we have to credit prepaid insurance to reduce that balance. So we credit prepaid insurance also for $100. So at the end of that journal entry, prepaid insurance will then have a balance of $2,300. And then you continue to make that same entry each month until the prepaid insurance is all used up. Here's an example to explain supplies. Fast Forward purchased $9,720 of supplies in December, some of which were used during the month. At the end of the month, $8,670 of supplies remain. So what that means is that $1,050 of supplies were used during the month of December. So at some point during December, we don't have a date. We'll just say December 1st. $9,220 of supplies were purchased. So we debit the account called supplies. That's an asset account. Remember, anything prepaid is an asset, and supplies are a specific example of a prepaid where we just use the account called supplies. So you always debit the asset for the prepaid and then credit cash if they paid in cash. So that amount was $9,720. So when you get to the end of the month of December, what you have to do here is look at the amount of supplies that were used during the month. The way that you figure that out is by looking at the amount at the beginning of the month. And then if you go take a look at what supplies are left and you see a dollar value for those, then you can just subtract that out and the difference will be the amount of the expense that you record. So here I've already figured that for us, and that amount is $1,050 of supplies that were used during the month. If they were used during the month, that means that you can now record it as an expense. So you would debit supplies expense for $1,050 because that's the amount of supplies that were used. And then you have to adjust the amount of the prepaid, which in this case is supplies. So you reduce the overall amount in the supplies account because now you've used some of them. So you reduce that by the same amount. So then what we'll have left is the $8,670 in the supplies account. Depreciation is another special type of a prepaid. It kind of falls under this category. So the way that we record assets, so machinery, equipment, buildings, things like that, when we first acquire an asset like this, we don't record any expense at all. So for example, if we purchase a piece of machinery, we would debit machinery and credit cash. So there's no expense that takes place there. The special adjusting entry that we do to record the expense of the machinery over time is called depreciation. We have to record depreciation because over time, as we use that asset, it loses value. It loses value over a period of time as we continue to use it. So each month we record a little bit of expense for that. So there are a couple of things. First of all, the machinery has to stay on the books at its cost. That is called the cost principle. It's just a rule. So on your balance sheet under the assets, machinery has to always equal the amount that it cost you to purchase it. So for example, if it was $50,000, then on the books, machinery will always be $50,000. But over time, remember, we have to depreciate this value. So the value lowers over time, but we can't do that specifically in the machinery account. So we use the process of depreciation to gradually reduce the overall amount of that. So what we do with that is we will debit an account called depreciation expense and credit an account called accumulated depreciation. And we can specify that that's for machinery. So when you look at your balance sheet, you'll have machinery, and it will be $50,000, and then you will subtract out any accumulated depreciation. I'm just going to abbreviate this. So for instance, we'll say after the first year, we record $10,000 of accumulated depreciation. So then the net amount on the books will be $40,000. So we'll still be able to have actual machinery recorded at $50,000. Then we see the depreciation expense that's recorded to reduce the overall value over time. And then we have the net or overall value of machinery, which is $40,000. So that's just an example. So now we can work a journal entry on our own. So the company purchased equipment for $48,000 on January 1st. It has a useful life of 4 years. Prepare the depreciation journal entry for the first year. So I always like to go ahead and record the initial journal entry just so we get the full picture of what's going on. So on January 1st, we'll look at that entry. The company purchased equipment, so we debit the equipment account. And we'll say that they paid cash, so we credit cash. And the amount of that equipment is $48,000. Okay, so the problem tells us that it has a useful life of 4 years. That means when we purchase the equipment, we anticipate to use it for 4 years and then probably have to get something else to replace it. So we depreciate the equipment over a total of 4 years. So if the cost is $48,000 and we depreciate it over 4 years, that means the depreciation that's recorded each year will be $12,000 per year. So when December 31st rolls around and we have to adjust the equipment account to show the depreciation, we don't actually adjust directly to equipment. This is when we record the depreciation expense. So we debit depreciation expense and credit accumulated depreciation. And that is for the annual amount of $12,000. So that then the net value on the books of the machinery will be $36,000 because that's $48,000 minus the depreciation of $12,000 will be the net machinery amount.